Welcome back. This is Alan Pickard with Pickard Insurance Services. I am a whole farm revenue specialist at my agency here. And this webinar is going to talk about whole farm revenue for cattle. There are lots of YouTube videos out there that have information on whole farm revenue. I've watched a lot of them, and a lot of them don't address the issues and the topics. It's more of an overview to see what you can see about whole farm. But it's just going to take you a little bit deeper than just the surface. So we're going to get started here with the whole farm revenue for cattle. Why WFRP or why not? The first one is we have the different types of policies you can buy for the cattle. One is LRP, Livestock Risk Protection. That is a price only. It is subsidized by the USDA, but it is very little subsidy against it. You can buy an option or a put, play the market a little bit, but once again, that's only a price-only product, and it is not subsidized. On that one, you're going to have to foot the whole bill for it. WFRP is a highly subsidized price and weight and death loss and disease product. So it's not just price like the previous two. This is price and weight. Or the last thing you could do is you could do nothing. You can self-insure everything. A lot of farms do that. We're getting into crunch time where money is tight. Bankers want their money back. They want to have something to protect what you're going to give them. This is a good product to do that. Whole farm revenue is. Doing nothing is a very bad product to do that. But it's up to every farmer that wants to, up to him what he wants to do. Why not? Whole farm revenue protection is tough to understand. You have to build the policy for you, the producer. Everybody is different. Every policy is different. Doing nothing is either. Self-insuring is a whole lot easier than doing the work. But if farming was easy, everybody would do it. The bankers say to buy a put or a call. Well, that only protects the price, remember, and that's expensive. They are not aware of how whole farm revenue protection works and how it can protect you, the producer. The LRP has always worked for me in the past. I'm just going to stick with what I got, and that's fine. You can do that. But times have changed, and we need to have more things and more understanding about the products we have at our fingertips. We're going to jump into a cow-calf scenario right off the bat. Whole farm revenue protects the entire calf over its lifetime. Whole farm revenue will cover the gain or the advance the calf is going to put on during the insurance period or insurance year. The nice part about this is you'll have a couple times to set the price with a couple of different weight options, whatever it is you're choosing, whatever fits your farm the best. The year the calf is born, you're setting price of it costs you to buy it next year. So it's kind of through the end of the year is how a lot of things change over to the next year. We don't insure the cows producing the calves. That goes into inventory. We're only producing the golden egg that the goose produced. In October in 2013 in South Dakota, we had a winter storm called Atlas. It killed a lot of cattle on the western side of South Dakota. If I could have sold this product in 2013, a lot of those calves would have been covered under this policy for death loss because they died. So you had that loss of revenue in your year. So this policy protects the revenue that those cattle are bringing in. Next, we're going to jump to feedlot. We will cover the gain or the advance that you put on during the calves in the year, just like cow-calf. Just like cow-calf, you have a couple times for pricing and a couple times for weight. Different weights if you want to share different weights. This policy caps out at $1 million. There's lots of misinformation about that. $1 million is talking about advance. We'll get to that a little bit later and how we discover that. Covers both ends of the cattle in different years. You kind of think about that. The calf is born one year. The next year you're going to fatten it out. It covers both weights and different at each year. So those are two different years we're talking. Under this policy on the cattle, especially the cattle or the livestock, we're going to call it, they have a 10-day waiting period before the policy takes effect. So you have 10 days after the application is signed before the policy takes effect. So if you sign the application on 3/15 of 2019, you'll have to wait 10 days before any revenue coverage starts with livestock. So if you sold something in February 15th of 2019, that revenue is not protected under this policy. The only way to have that revenue protected under this policy is to sign the application 10 days before the sale date of the cattle. Here at my agency, I like to have all of my feedlots or most of my feedlots done, or the cattle, livestock done January 1st. So we have that whole protection through the whole year. The 10-day waiting period is only for new insureds. If you have a carryover policy from the previous year with a different company or different agency, you're covered from January 1st on. It doesn't matter. But the 10-day waiting period is only for new policies. An idea of what you're looking for against the schedule kind of helps us on where we're getting our cattle numbers from. You need the last 5 years, not including the lag year. That's how the policy works. We're going to look at 1C. That's our net or advance on cattle. That's really the number we're after. It takes a little bit deeper on how to drive from that to that number, but that's the number we're after is in 1C. It's only delivering on the crop or only delivering on what produced the revenue. If you're selling bulls on tree or private sales, we can cover those guys. It's a little different scenario and a little different way of doing it, but that's driving from the sale of the crop. Since we're at the Schedule F, if you have a cow-calf operation, we're going to want to see the depreciation or the Section 179. That'll kind of help us with the policy. The income that drives from the crop, if you're custom feeding cattle, so you don't own the cattle that are in the feedlot, then the sale of the feed is what you're protecting in the policy. This is some feedlot numbers that I just kind of put together for this presentation. I got them off the LRP prices. I can show you here in a little bit how the easiest way to go find an LRP price is at. Difference in prices and the price drops. Fed cattle LRP price in March of 15 was $1.61. In 12 of 18, it was 98 cents. That's 63 cents drop. I realize that's over 3 years, but it still brings home the point. So at 63 cents, if you did nothing, that means you self-insured with 63 cents. You have a 1,200-pound critter, that's $756 a head that you self-insured. This policy would cover some of that $756. Steers weighs one less than 600 pounds. If same scenario again, 315 was 248 a pound. 319 is or will be, according to the futures, 158 a pound. That's a 90 cents difference. If you self-insure it again, that's what you're after. The whole farm will protect some of that $450 that you lost. Who covers the loss and what are the expenses? Is the banker going to cover the loss? The LRP could cover the loss if it was just strictly price drop. And if it was the price drop in that time period that you picked. Buying an option. Once again, the buying an option is basically LRP is a glorified option other than the fact that LRP is subsidized. Or you could buy a whole farm revenue protection that's going to cover the price. It's going to cover the weight. It's going to cover the critter for its entire lifetime, not just a certain period of time. I told you a little earlier, I'll tell you how to go find an LRP. So we're going to do that right now. I usually go to ArmTech. Let me get there just a minute. Here we go. I'll slide that over so you guys can see it. There we go. I go to ArmTech Insurance. You can go to the USDA site as well. I use this guy. It's a little more easy to work with. I don't sell LRP, but it's on the internet, so we can go there. You're going to go to Producer. You're going to go down to LRP Quoting. You're going to pick the day you the effective date. You can go back all the way from 2018 all the way back to 2004. So let's just pick a day here. You're going to pick your state. I'm in South Dakota. You can pick whatever state you want to. If you're, let's say you're in Missouri, you can pick Missouri and it'll go right to that. I'm in South Dakota, so that's where we're going to be at. We're going to be under fed cattle. You have your choice of fed cattle, feeder cattle, or swine. Fed cattle always steers heifers. You're going to put in, I always put in 100 head, 1,200 weight. Share is 100% or one. We're going to calculate it out. And here's where we get our price. So on effective date, 12/14, we're going to go out. We're at $1.16 a pound. This is where we'll get some of our prices for the LRP. So it kind of gives you, or the whole farm revenue, excuse me. It gives you an easy way to look and easy way to figure out what's happening and where it needs to be at. That was a quick view of how we come up with some of those prices. This is all we have for right now. You can stay tuned. We'll have some more videos on explaining how whole farm revenue protection works for you, the producer, with a better understanding and easy way to see it. If you have any questions, please contact me at this number and just ask for Alan. I thank you for tuning in.